Investors are dead wrong about DSCR loans, and those misconceptions are costing them deals, money, and growth. I hear the same myths over and over. Things like the rates are too high, you need dozens of properties to qualify, or banks don't really do these things, but none of that's true. If you don't know the truth about DSCR loans, you might dismiss the single most powerful financing tool available to real estate investors today. So here are the 6 biggest misconceptions about DSCR loans. Before we get into it, I'm Andrew Russell, owner and founder of RCG Mortgage, 4-time winner of Broker of the Year, top originator across the country via Scotsman Guide, and I specialize in working with investors to get them the right mortgage products and achieve real estate riches. All right, so let's get into the 6 most common misconceptions about DSCR loans. But first, let me write them all out. With the magic of editing, it'll appear quite quick.
A few moments later.
Ugh, that was siren. Give myself another Celsius. All right, so we're going to go into the 6 biggest misconceptions about our friend, the GOAT of all mortgages, the DSCR loan. Before we do, make sure you go in the description, click the link, and download our DSCR mortgage guide, the GOAT of all mortgages. Our team spent so much time putting this together for you guys. It's free. Go in the description, click the link, and get our guide to DSCR loans, which, if you're an investor or going to be an investor, could change your life and your whole real estate portfolio. So the first piece, income docs. So, hey, Andrew, if I get a DSCR loan, just like all mortgages, I got to show all my stuff, right? My pay stubs, maybe I earn money in all sorts of different ways. My tax returns are a hot mess. Nope. So income docs, don't need them, don't want them. So the benefit of a DSCR loan is it's based and qualified off of the market rent. So for argument's sake, scenario we do here a lot, $1 million sale price, 20% down, $800K loan. This is very quick, 7%-ish rate, 7.5 APR. Say that's $5,600 a month for the mortgage, right? Principal and interest. Let's say that's $7,000 a month all in, which includes taxes and insurance as well. Just super quick and rough. So that's $7,000 a month. That's our focal point for qualification. Now, if this is a 2-family property, say in each unit gets $3,500 in rent. That's $7,000 a month in rent. $7,000 covers a $7,000 mortgage. Isn't that simple? That's all we look at. That's the most important thing. But just remember, this 2-family, this over here market rent, this is done by the appraiser. So if you're buying a property DSCR and you're going to get a mortgage and the payment is whatever it's going to be, you have to be certain when you're going into contract that the market rent, which the appraiser will estimate, is going to be very close. It's the typical formula. There's a lot of different iterations, which we'll talk about in a little bit, but that's the typical qualifications. What makes it super cool is no pay stubs, no tax returns. Bank statements now, they're allowing 1 month and not even going crazy, guys, about large deposits. But when you wanted to buy an investment portfolio before, you needed to, pay stubs, W-2, see what your current housing expenses versus your income. Market rent, we only could use 75% of it to wash the mortgage payment, not 100% face value like we can with the DSCR program. So the biggest misconception is it's really hard to buy an investment property, at least multiple, because we're going to have to supply so much paperwork. And Andrew, I'm sick of supplying paperwork to mortgage professionals. Well, guess what? On the DSCR side, think about it. If you're buying a property, you need the contract, copy of your ID, a month of your bank statement showing that you're eligible for the down payment and closing costs, like you had the funds, and maybe if title and deed is going to be an LLC or corporation, some of the corp docs, and that's it. None of the other stuff. Super cool. But that's the first one. Very popular. Almost as popular as the second one. Hey, Andrew. Rates on these are naturally through the roof. If you get a normal mortgage versus a DSCR, if I walk into my local bank, I can get a great rate. If I reach out to you, Andrew Russell, owner of a mortgage broker company, the rate's going to be through the roof and it's going to be almost predatory. Well, that is not the case. So if we have a rate conversation right now, guys, so if we have a rate of, say, 6%, we'll put it over here. If that's the going market rate, now, when the DSCR program first rolled out, a little bit before COVID, and it was more at mass for mortgage broker companies to be able to offer this to their clients, the margin or the difference between the going 30-year fixed rate and the DSCR programs were anywhere between, let's say, 2 and 4%. So that meant the going rates were between 8 and 10% based on current market rates. Back then, like I'm so old, right? It's not like I'm turning 44 soon. If the rate was in the sevens, I saw them as high as 11%. But that was the margin when it first came out because the secondary market didn't know if investors were going to pay these on time. So they built in a nice little hedge, a little margin for income purposes because they were going to offer them. They were going to at least make a little bit more upfront because they don't know if the market's going to pay these on time. And if they don't pay them on time, then there's losses in the secondary market and they don't want to do these for a loss. So the margin, they were kind of testing the market to see would these clients with no income documents be able to buy these properties, the rent covers, and they'll pay their mortgage on time. Turns out, I guess they do. So now, this is old, this is new. So now, say the rate's 6%, we're seeing margins are 0 to 1.5, which means I just priced out for a real estate agent that I was just speaking with a 50%, which is very low. It's like 50 to 60% financing, a $1.8 million purchase, a loan 8-ish, 100,000 to about $1 million, which is putting a lot of money down, which is exceptional. And if the going rate right now was 6%, 6.125 was the quote this client got on a DSCR loan with no prepayment penalty, which is exceptional. So just proves the point that the biggest misconceptions, one of them is the rates being so much higher than the next programs, than the conventional programs, than the vanilla stuff, which is just not the case. Back in the day, maybe the rates were a little bit higher, 2 to 4% margin differential between the going rate and a DSCR loan is quite high. 0 to 1-ish% as a margin is very low. You can potentially be 2 teachers buying a primary house with 30% down with 780 scores and get a great rate. But if you were putting 5% down with 640 scores, 2 teachers, maybe that rate is 1% or a little bit more higher. So the margin here is very acceptable. Myth number 2, definitely here debunked. The third piece, the massive portfolio, meaning you can't get these loans if you don't have all the experience in the world and you don't have a massive portfolio. That's actually not the case. So I want you to think of it as a bunch of different things. First-time investor, first-time homeowner. So the 2 big things here are you a first-time investor or even a first-time homeowner? So first-time investor, that was the thing, right? When the DSCR loans first rolled out, they wanted you to potentially be a continual investor. They started to allow first-time investors, which is maybe you got a loan-to-value haircut or the down payment had to be a little bit higher. So instead of 20% down, as a minimum for a 1 to 4 unit property, they're like, if you're a first-time investor with no experience in this stuff, maybe we'll jack that up 5%. So now that 20 went to 25% as your down payment requirement as just a teeny overlay. So again, if you owned a house and you wanted to become an investor in properties, but for whatever reason you've never done it before, but you want to do it, you want to get into the space, you want a DSCR loan, maybe years ago, instead of 20% down on a 1 to 4 unit, maybe it's 25% down. And that's just because there's a little bit more risk. They want to make sure you have more skin in the game. Then all of a sudden, first-time investors, not first-time homebuyers, first-time investors, they were giving them listen, as long as you have a certain credit score and certain money's left over in the bank, we'll give you that full 20%. We won't require you to put more money down. So that was the first big change that I saw. So this common misconception of, unless you have a massive portfolio of investment properties and you're a seasoned investor who's done this multiple times, you're going to have to put a lot more money down than being a seasoned investor. If you don't have this huge, massive portfolio, it's going to be either problematic or you're just going to have to put so much more money down. So that was the first thing that changed over the last handful of years, which is if you're a first-time investor, but you are a current homeowner, you can actually get the same program as if someone owned 10 of these before, which is super cool. Made it an even playing field. The second, the most recent new thing is you can actually be a first-time home buyer, a first-time purchaser, and use this program. Now think about that. You're living at home, in a van down by the river. No, you're renting your property, and you're like, you know what? For whatever reason, I'm not ready to buy a primary house, or maybe you want to buy an investment property in another area. You live in New York, you want to buy in Miami, or vice versa. Or you live in New York and you want to buy something maybe more upstate on a lake. They actually allow first-time home buyers and first-time investors to be the ones who are now using DSCR loans. A couple different overlays, maybe a certain credit score requirement. Maybe instead, again, the 20, it's now 25% down. Maybe they require, which they oftentimes do. If you're a first-time home buyer, do you have a current housing expense? They're going to want to see that, not living rent-free. Are you paying rent? They're going to want to look at your last 12 months. So you can actually get a DSCR loan, no income check, great interest rate, with no experience, if you're putting maybe 25% down instead of 20%, it's no big deal, right? I mean, you have no experience owning a home, so it's pretty liberal if you ask me. You're paying rent now, so you show that you have the ability and the wherewithal to make a housing payment instead of just living rent-free. And maybe you have a couple more months worth of mortgage payments. Say that mortgage payment was $7,000, maybe an extra 3 months, $21,000 in the bank on top of the normal program requirements left in the bank. So just remember, guys, reserves, we talk about it many times in all our videos. If $7,000 your mortgage payment, so if you have 12 months left of it in the bank after you close, it's $84,000. You have a year worth of reserves, which looks really good. Meaning if the world ends, proverbially, of course, you have a year worth of payments left in the bank. You shouldn't have any issues paying the mortgage, of course. So maybe for first-time buyer, instead of 12 months, they require 15. But the point is that you don't need a massive portfolio. Not only has it given opportunity for first-time investors, first-time home buyers, it's also given opportunity to. So they don't own anything, and their first loan could be a DSCR. That's a huge, misconception, and that's a huge characteristic for these loan programs because it just opens up the floodgates to more buyers being able to utilize the DSCR loan. Fourth option, of course, it has to be, to our example over here, from a market rent perspective, the L stands for long-term rentals. It's actually not the case. Now they allow for short-term rentals. Now imagine this $7,000 a month property, right? Say this was a house on the lake in a really expensive, cool area called the Hamptons or Lake George or maybe somewhere in Miami, as an example. So that's $7,000 a month. Say it's a 1-unit now. We're talking about this scenario as a 1-unit property. Now say if that's rented all year, throughout the year, maybe it's $3,500 a month in rent. Now that is nowhere near $7,000, so maybe it doesn't qualify for a DSCR, but it's a seasonal property. Maybe in May, June, July, and August, each month gets $40,000. So you figure you have 12 months of rent, but just May, June, July, and August, maybe each month gets $40,000 in rent. So if you do the math, who cares what the other months are? Maybe it's just super hot in the summer, for whatever reason. This is a likely example. If you put together all the monies you can make on Airbnb or short-term rental, it's $160,000 for the year, which 7 times 12 is $84,000 for the year. So as you can see, if you just rented it those 4 months, it would almost double the mortgage payments for the year, regardless of the other 8-ish months. So this, as a misconception as well, you don't just have to go off this low, where do we put it over here? Right, 3,500, there you go. My chicken scratch. So the 3,500, say if you took this property and you had to rent it for 12 months, maybe it's just not that appetizing during the winter months, so someone's only willing to pay $3,500 a month. But if you rent it out in the summer, if you just did daily rentals for the summer, you could do $1,000-ish a day, right? Which would be super cool, just depending on the season. This is something that is very popular now, that we can qualify clients on a DSCR based on short-term rental. They have to do their diligence, talk to their real estate agent, say, hey, this property, how much can it rent for in just the summer months or just the seasonal months? We get that on an appraiser, market rent off of the appraisal, the same thing off the short-term side, but you can qualify to buy a house with a DSCR loan just going off short-term rental, which is super cool. Fourth piece debunked. And of course, guys, before we continue, just make sure, again, go in the description, click the link, get our investor mortgage, DSCR, the goat of all mortgages, our guide. It's exceptional. So go in the description right now, click the link, and before you forget and go to a different video, make sure you download this guide. It is exceptional. If you're getting into the real estate investment space, and think about it, even for a second, entertaining any of this DSCR stuff that we're talking about, make sure you get that free guide. It's in the description, and click the link, guys. All right, number 5, scale, meaning it's impossible to scale. You're going to be capped. So believe it or not, you're actually not capped. So on the conventional mortgage side, or even portfolio, meaning walking into a local bank, something of that sort, credit union, sometimes they cap you with the amount of houses they allow you to buy. Sometimes it's only 4. You can only own 4 properties. Sometimes it was up to 10. These have absolutely no cap. So it's just as simple. Here's a scenario. There's a scenario. It's like Oprah, right? There's a scenario. There's a scenario. So whatever your scenario is, as long as you have enough money for the down payment, the closing costs, the property cash flows, meaning the market rent covers the mortgage, and then you have some money, we said reserves, right, left over in the bank, there is no limitation to scale. So you say to the moon, you can do this as many times as you want, over and over. And as long as each individual transaction works, then you qualify, which is super cool because typically investors, they might get sweetheart deals all the time. And they might think like, oh, I'm capped at a certain amount either in general or per year. These specifically have none. So, I've heard all the time, hey, Andrew, this DSCR loan sounds so super cool. How many of these can I get? I probably only can get like 4, maybe even max 10 over the lifetime of myself being in the investment space. So the answer is actually no. As long as you qualify for the loan itself, they're all individual typically. You don't do blanket. Like, so in other words, hey, I'm buying 10 one-unit properties all like within one. That becomes more of a commercial loan with different guidelines. On the DSCR side, as long as it's individual transactions for the properties, there is no cap at scale, which is cool. You become the biggest property owner across the country as long as you could afford each transaction that you're purchasing. And the last one, the most important, again, if you apply for a mortgage, typically there's 4 institutions you can go to. You can go to an FDIC, great huge companies like Wells Fargo, Chase, Citizens, Citibank, they all offer mortgage typically. Then you go to a CU, a credit union. For instance, in New York, there's 4-Leaf, Teachers Federal, plenty of credit unions across the country. Third is an MB, a mortgage bank. And then fourth, save the best for last, is a broker, a mortgage broker company. So what makes them all special and unique is an FDIC is a depository institution, same with a credit union. They typically don't offer DSCR loans. Why? Because it's the non-QM space. It's not Fannie, Freddie, FHA, VA, their own money's portfolio. It's the non-QM, like a different-ish type space, the securitization, the mortgage-backed securities, all that stuff, which that's a little bit confusing and convoluted. It's just not their realm of superpower. So typically, if you're banking with one of those institutions and you walk into the branch and you sit with an amazing rep at the branch, they're going to say, well, listen, unfortunately, these loans, I've heard of them. We just don't offer them. The same thing typically with a credit union. So that already disqualifies option 1 and option 2. So unfortunately, to the misconception that no one offers, you're right. Sounds like no one offers, but that's when you go into mortgage banks, which now do, and especially the winner, chicken dinner, mortgage broker companies definitely do at scale. So mortgage banks are great, but that's one bank. You're only as good as what that one bank offers, where mortgage brokers work with all of the mortgage banks. Because remember, DSCR loans, these are coming from non-depository institutions, mortgage banks. So huge companies, often backed by hedge funds, but you don't have checking with them, checkings and savings and 401k. They specialize in the mortgage banking sector, and they're lending out their own funds, usually through a warehouse line, but they're lending out to all different mortgage banks or broker companies or them direct to consumer. And they're just companies that are excited for the space, but they're not FDICs, depository institutions, or a credit union. So it's interesting who has access to these places. Of course, you could work for the bank yourself, the third option, or work directly with the bank yourself, or you can work with a broker company, which is always the best. Why? Because think about it. If you work with a mortgage broker company like, I don't know, Andrew Russell, for instance, an RCG Mortgage, we will shop your specific scenario. Again, $1 million sale price, 20% down, $800,000 loan, a 1-to-1 rent ratio, depending on where it is and how many, 2-unit property as an example. We will, in our portfolio of all the lenders we work with, which it's on us to get with all the best price lenders and the best service-based lenders, which is obviously our superpower, goes without saying, we will put in the specific scenario and it shows us from best price to worst, all the lenders that we work with and who has the best rate offering, which we then pass through to you. So basically, when you work with a mortgage broker company on the DSCR side, you are only having to apply one time with us, and then we take that credit and all your qualifications, and we do the proverbial shopping around for you. So these specific DSCR loans, the misconception that no one offers, people do offer, but how do you get access to it? You can either go direct to the mortgage bank, or you can do the prudent move and work with the mortgage broker company who has access to all of those who offer it. So it totally crushes the misconception that no one offers. You, meaning the consumer, just have to go to the right person who's working at the right mortgage company, a broker company, who has access to the right lenders, all the DSCR lenders, to kind of flip that narrative on its head, where no one offers. No, mortgage brokers offer it at mass. All right, guys, make sure you go in the description, click the link, download our GOAT of all mortgages, our DSCR guide for home purchasers. It's an amazing guide. Go in the description, click the link, and make sure you get it because it's free. So now that we just went over all the misconceptions of DSCR loans, make sure, guys, you watch our next video for DSCR loans. The frequently asked questions: how do they calculate market rent? How do I qualify? What credit score do I have to have? How much do I have to put down? So it's cool to debunk all the misconceptions, but make sure you watch our next video that goes over the whole DSCR loan and exactly how you qualify.